Hello, everyone. We're going to get cracking. There's still some people to come in, but we've also got people joining us in Europe and elsewhere online as well. And so, hello to you, and hello to those of you watching this on catch up as well. Great to have you with us. Very interesting and rich set of topics we're going to cover in a moment. The future of money, tokenized deposits, stablecoins, and CBDCs. We can and do easily spend a whole day on all of that, but we're going to spend 70 minutes instead. I've got an excellent panel here to look at that with us. OMFIF, through its Digital Monetary Institute, is looking intensively at these themes all the time, and has watched with great interest since Facebook frightened the hell out of all the regulators and got the commercial banks moving into this area. So on the panel, we've got Rana Kortam, Director, Global Public Policy at Binance, Naveen Mallela, Managing Director, Onyx Coin Systems at JP Morgan, Andrew McCormack, the Chief the central head for the Singapore Centre at the Bank for International Settlements Innovation Hub, and Sopnendu Mahanti, Chief FinTech Officer at MAS here in Singapore. We'll broaden the discussion out in a moment, but I want to turn to you first, Sopnendu, because we're, after all, in Singapore, and you're from the central bank, but also to give MAS credit where it's due. You saw DLT coming a long time ago, setting up sandboxes to experiment with it already in 2015, something like that. So I wanted you to give us a very quick snapshot of what MAS has been doing in this area. You're involved in all sorts of domestic and cross-border projects. So give us a bit of a tour of the horizon from MAS's point of view, why you got into DLT, but also the related scene of the upgrade of transaction services and payments.
Well, Saul, okay. Thanks for having us, and you would have not chosen an interesting time to ask this question. We're right coming off a massive issue on the market side with the FTX issue, and when I was talking to the other day, the complete fiasco of ASX, who spent 6 years right now, 6 years on trying to change everything about an exchange, and $250 million, and they decided to write off that expense. And on top of that, I think a day later, then TradeLens, the IBM big platform with banks participating on a DLT-based network for trade finance, decided to call it a day. So
I'm going to ask you why, but in a minute. But carry on.
And then if I look across the whole last 3 to 4 years, all major use case which was driving DLT adoption, especially in trade finance, only one has not still surviving. The rest have kind of folded down. So you asked the question. MAS was an early starter. I mean, we're still in a journey, but does this change, this massive event in last couple of weeks? In fact, I would say we all got distracted with FTX. To me, the biggest event was the ASX.
Right.
It was supposed to be the leading light of showing how DLT can change everything in a different way, make the processes super efficient, and that collapsed. So to me, that's a bigger market impact on this whole technology. Now, your question on the journey, we have taken this approach of experiment and get the industry behind it, be thoughtful about how we move about this whole space. And as an outcome of that, Singapore has benefited a lot, I must admit, because we have a lot of blockchain companies, DLT companies coming to Singapore, experimenting with the banks, putting solutions out there. Some are still successful in their own way. But with this major impact, we started looking at it, what caused this issue. And I'm sure we're going to talk through this panel. So one thing, as an opening remark, I would say, yes, we are still invested on the DLT as a technology of which can add value to think differently, the way you think about business processes. I'm deliberately using the word business processes because it is a process change. It is not a technology change. If there's a technology change which supports that process change, I think our consistent refusal in accepting the business process change could have caused this technology nightmare. I mean, one thing, I don't know, Navin will now agree with this reflection with this crisis. For many years, we have pushed back on an open blockchain. Public blockchain is a bad idea. If all the crisis today we saw was actually an outcome of trying to make regulators happy, building a permission blockchain, which means we can govern well, there's a central party, looks good, but look at what happened. One of the root cause of this collapse is that somebody, one or two person have disproportionate control over the network to cause this collapse. And I think it's a time to go back to the original design of this network, which is supposed to be truly distributed, truly running on a public blockchain like internet. And I think deviating from that thought process and trying to fit the narrative to the incumbent comfort zone is one thing I am personally taking away as a lesson learned in this major event happened last couple of weeks. So that's one on the DLT side.
Yeah.
On the currency which was powering this network as an incentive token, I think we still believe that's the model. We should always think about what is the value of these currencies, why they exist in the first place. Are they there to exist as a speculative asset, or their existence because they power certain incentive model for this distributed network to operate on a public blockchain? Go back to the original design. Is that what the real purpose of the cryptocurrency is? Time for us to reflect on that. Now, the good thing, because of this pressure points, central banks also started taking some of the tech stack out of it and start implementing on their own thinking around CBDCs, including commercial bank on their own thinking around wholesale process. I think that will continue. And to prove the point, otherwise, in India, the largest, if you look at population, India, China, half of the world's population today are in some form actually getting into production grade retail CBDC, which says that almost they're going in opposite direction. While world is thinking about the whole digital currency, India and China are showing that there's an appetite to think differently about digital currency. On the wholesale side, I think we are pretty much confident working with the banks and the private sector, with BIS, that there is a play for wholesale CBDC just to fix the age-old problem of settlement, reconciliation, cross-border.
There's still quite a lot of complicated and difficult issues related to CBDCs, even though, as you say, there are huge numbers of people already using them, and we're going to unpack those in a moment.
But I'll not say Cuba, at least two large countries willing to experiment retail CBDC is a significant move. Certainly. It may be experimental in nature, but that's a huge signaling.
And with respect to Singapore itself, I think that you're not particularly interested.
No, we have introduced experimental. We don't call it retail CBDC. We call it purpose-driven programmable money, where we can program money for a particular use case if there's a need for that. And that's the experiment we are doing now called Project Orchid. So we'll continue that path. But we don't see a commercial large-scale deployment of retail CBDC in that form. But it's not a small country to figure out what's the future retail CBDC, and most of the narrative will come from large countries.
I don't want us to spend much time on FTX for various reasons. The common view is it's essentially a fraud issue rather than a technology issue. But Ran, I thought we'd briefly put the FTX issue to one side. Swapnendu was sort of implying that there's a survival of the fittest process going on at the moment. Binance maybe will be a beneficiary of that. What's your view of the FTX saga briefly, and what do you think the prospects are for DLT and Binance's role in it?
To your point, the fittest will be the most prudent companies at establishing risk management. So it's no longer a question of regulation coming in. Like, companies need to take proper risk management measures, and this will be the differentiator. Anyone that doesn't will not survive. And that's the main point I want to articulate here. What happened at FTX is fraud. Customer assets were being loaned out without their consent or knowledge. And that has happened in many industries. And with a lack of proper risk measurements in place, It will continue to happen. So it's on Binance. We're the largest global cryptocurrency exchange by volume, but it's on us and every player to hold themselves to that higher bar to win back trust in the industry. It definitely hasn't been an easy few weeks, but it just puts the onus on everyone to do more.
The FTX looked to me like an incredibly badly regulated bank from days gone by, where you had a prop trading desk connected to something taking deposits and not a proper Chinese wall between them. That seemed to be the essential problem to me.
So there were customer funds being loaned out without their consent. There was debt being taken out against the company's native token. And that's absolutely, I would say, not advisable at any point. So maintaining a fiscally conservative capital structure is another advice for any cryptocurrency exchange out there. For instance, Binance maintains a debt-free capital structure, and in any case, that cannot be collateralized in your native token.
We've heard over the last couple of years, there was initially a great excitement, perhaps 18 months ago, about DeFi, DLT and so forth, and then all sorts of problems, theoretical problems emerged, and then we've had some practical problems with badly designed stablecoins and exchanges and so on. But would you be willing to re-articulate the benefits of DeFi and DLT to cheer us up after Sokmen Du's sobering tour of the horizon?
I'd be more than happy to do that. There are so many benefits to decentralized ledger technologies within and outside of financial services. For the sake of this panel, I think we're focusing more on payments. So stablecoins, for instance, when properly managed and collateralized, and by properly I mean one-to-one, against a stable, ideally fiat asset, have shown their ability to provide real benefits, especially when it comes to cross-border payments, for instance. The FSB's 4 goals for improvements for targets for improvements on cross-border payments are cost, speed, access, and transparency. And stablecoins have shown their ability to deliver benefits on all 4 of these, especially the transparency bit, to your point earlier. I think cross-border payments are, nobody talks enough about their importance in the global economy. Like 15 to 20% of e-commerce is already global. And that's one use case of just retail payments. Cross-border payments can be categorized in a wholesale, retail, and remittances. And remittances are often not included under retail. But even remittances alone are a $589 billion global market that has been dominated by mostly traditional financial services providers. And there has been a lot of innovation in the fintech industry as well. But stablecoins and blockchain in general have been able to improve the speed and costs of many of these transactions, with stablecoins offering the added benefit of stability of value when properly collateralized. When
they're properly designed. And we'll explore that. We'll explore that now with you a little bit, Naveen. The implication from Rana is that commercial banks are conducting transaction services more expensively than they might if they had access to the benefits of DeFi. Tell us a little bit about your view on that. There are all sorts of other obstacles actually on KYC and AML, I'm sure we'll come on to, but I'd be interested in your view of the benefits of this technology and what JP Morgan is doing with it. You've got an interesting deposit coin project, so tell us about that.
Sure. Maybe just to pick up from where Rana was talking about, I do agree with all of her observations in terms of cross-border payments continues to remain challenging. Domestic payment infrastructures have improved by leaps and bounds. UPI in India, Pix in Brazil, and many more have delivered instant payments 24/7. Cross-border is where the challenges continue to lie. It relies on correspondent banking. Banks like us, are the ones who are running the rails, but there are obvious challenges in an account-based model. So we firmly believe that message-based infrastructure, which is what powers the card networks, SWIFT, will give way to token-based infrastructure going forward. And that is where DLT can play a very useful role in terms of these token-based pipes. We do think that the future of payment networks is going to be open loop. So closed loop networks like wallets which have done a really good job where payment infrastructure has been found wanting to create a rich user experience. I think that will give way to open loop. Already wallet companies like Paytm in India are struggling ever since UPI has come on board. I think the same story is going to repeat with Alipay and every other wallet companies. Third thing, which I will probably differ a little bit from my co-panelist Rana, is that I think that the future of money is going to be commercial bank based. I think that central bank money and stable coins will coexist with commercial bank money, but the dominant form will be commercial bank money, because stable coins one-to-one backed will not go to the scale which commercial bank money can, because there isn't enough of HQLA.
It's just a narrow bank.
Yeah, it's just a narrow bank. In the heydays of the now defunct Libra, it was hypothesized, I think, by ECB that if Libra were to scale, it would take all of the short-term debt of A+ countries in the region. There isn't just enough HQLA going around. So the future of money is going to be commercial bank, because it's fractional, and given the prudential regulation, given the capital and the liquidity requirements, this will be the dominant form of money. So our deposit tokens are looking to leverage on all of these trends: token-based infrastructure, open loop, and commercial bank being the scale form. So I agree with my co-panelists. Stable coins have shown us the way in terms of the efficiencies which can be brought about, and deposit tokens will only scale that.
Well, just for the stable coin,
yeah,
I think there's a middle path. Low value, below certain threshold, well-regulated stable coin, not necessarily everything's backed by US dollar, but backed by respective sovereign currencies, can operate efficiently below a certain threshold just to avoid any monetary policy implication of the country. That can be super efficient than a fractionally backed coin. I think that if you split the segment and keep it below, let's say I'm just making a number, $1,000, anything below $1,000, a rupee stable coin, a dollar stable coin, a Singapore stable coin, they can run on the network efficiently. It can be kept away from complicated capital control rules. Nicely done. It can solve really small, low-income migrant workers' requirement.
Digital cash. You're talking about digital cash, essentially.
Cash, yeah. This is pure digital cash.
Yeah.
Just small value, digital cash, small transfers sent by extremely poor people, migrant workers. If you take that use case, you carve out huge volume globally, and that, I think, stablecoin will be a little more efficient than bank-backed, fractional reserve-backed currency. But with Naveen's point is definitely spot on. Anything above a certain amount, stablecoin will struggle.
Would you? I want to come on to Andrew in a moment about how all these things will interoperate. We spent an hour or so talking about that at Cypos. We'll come back to that. But Sopnendu, how would MAS or similar institutions choose to regulate a stablecoin? Wouldn't essentially just become banks anyway over time? Perhaps they've even got national reserves. Then you just started.
I think somebody said that if you give everything, if you regulate them like a bank, and one is backed one-to-one, one is backed by fractional reserve, which is efficient. Of course, the fractional reserve is efficient.
Yeah.
But I think that's why I deliberately split the segment. If there's a way to do only small value transfer, because when banks do a big transfer, they have to comply to a whole set of rules, multi-country jurisdictions rules, capital control rules, LRR, SRR, all kind of rules kicks in. There, I don't think stablecoin will be efficient.
Right.
So I think you should look at a segmentation of consumer where they address the real problem, and if you can solve it using stablecoin, be it. But a fully regulated stablecoin and a fully regulated bank, the cost of regulation will be identical.
Yeah.
And the cost of capital backing that will be,
it's just another bank. So your view, the point of stablecoins would be a more efficient, low,
provided the respective country allows certain exception on the capital control rules wherever it exists.
Yeah,
and that's the reason why today the India-Singapore corridor, which is getting connected, is going to be efficient in normal rails, because we have taken certain exception on the capital control side for small value. Yeah. But that is not sustainable globally.
That sounds like a difficult thing to harmonize.
Yes.
Andrew, let's come on to you on exactly that topic. So we may have a JP Morgan deposit coin. We may have DeFi and stablecoins and other tokens from Binance and others. We may have central banked digital currencies. How is all of this going to interoperate, and actually, would it leave us more fragmented and actually lose us some liquidity along the way?
Yes.
What are you going to do about it?
So I think, what's elegant about the way the payment rails work today is, yes, of course, most of the money in circulation is commercial bank deposits, basically, right? But what's really elegant about it is these layers are loosely coupled. So what allows for a JP Morgan deposit to be transferred to a DBS account is that there's a foundational layer of a public good called central bank money, and that settlement process is, has been fit for purpose on a domestic basis for many years now. So the real question is, as these new methods of payment emerge, whether they're token or account based, how do they interface with those layers that allow for fungibility across all the players in this now more complicated, ecosystem? I do not have the answer other than to say, we have to think from our perspective as central banks and the BIS. We think about how do we make sure those public goods are fit for purpose for the future, payment ecosystem, let's say, because I do think there is still a need for that core public domestic settlement infrastructure. And frankly, there is no equivalent of a domestic RTGS on a cross-border basis today. So that's a very challenging problem to solve because you intrinsically have to solve the FX piece and liquidity around that. But what we kind of need in this future state is that I think basically cross-border RTGS that would allow for that to come into existence. Now, exactly how that gets built is a matter of debate and discussion, but that's, I guess, what we're all kind of working on some level.
Which do you think would get there fastest? Cross-border harmonization of those kind of standards, or perhaps a new currency of the sort that Facebook was proposing that would get rid of the FX problem? They're both difficult.
Yeah, that's not a silver bullet. I mean, there's been SDR and things like the sort of basket type currencies. It's not necessarily obvious that that's a silver bullet. There does have to be, I think there's going to be a need for, reference currencies and reserve currencies, and maybe more than one. But I think the liquidity in those environments is critical. But how do we actually incorporate those into these larger cross-border flows? Because I agree with Sapnendu, the low value stuff I think is somehow solvable, even with the infrastructure we have and with a few tweaks and a bit of creativity, we can get there. But I think it's that bigger, high value, and I know Swift is obviously working on this and thinking about how their services will evolve, and I think we're all on the same page.
Yeah, I think the key, we have to think the problem statement. Is it today possible to send $100 transfer overseas on the message-based account network? Just not possible. It's expensive. The cheapest way is to move cash. Why can't we tokenize the damn cash, well regulate, and move that small value cash? And that's the argument I'm making. So that's essence is try to solve the problem, not to create technology because we love that technology, message-based technology or a token technology. We should all drive to solving that problem. So my problem statement to everybody: can you move $100 cash with $1 expense?
And well, let's explore that a bit. What's necessary to make that happen? It could happen organically around regulation simply because people vote with their feet in a useful version of money that someone might create, or central banks may work together through BIS to create a common set of standards and communications tools to cater for it. How do you think such a thing will evolve, and would it be bilateral or a multilateral? But
by design is not possible. If you're going to move from an account-based system, the cost inherently is so high. You can't move $100 cash between 4 accounts with 10 regulation checking.
Yes.
Right?
Yeah.
It's just not possible. The only way to do is to think like cash.
Yeah.
Today, the only regulator in the cash is the custom official who checks how many cash you have brought into the country. Instead of that, build a network, move the cash.
Will that
tokenize? So, to his point, tokenize the cash on a network.
Would that restrict the type and number of countries that would allow it to take place?
I don't know. I mean that's should not be a problem if I think there are countries. If you look at stablecoin, if you talk to Reserve Bank of India, they were here, and I think their concern is they don't want to dollarize the country using US dollar, using USDC.
Yep.
They want to ensure that if the cash has to be tokenized for a low value transfer, it has to be their reserve currency backing assets backing that stablecoin. So that is there.
Right.
If that is possible, that is available, there should not be a problem.
Just on that topic, you're essentially talking about monetary sovereignty, and that appears to be one of the drivers for CBDC. We're publishing a report later today in London called The Future of Payments, which has got a survey about CBDC plans from banks, and they're all interested, doing it faster than you expect, but don't agree about the reasons to do it, which I think is interesting. One of them is monetary sovereignty. So if you take the example of Hungary in Europe, they are trying to move faster than the ECB because it would be easy to imagine an accidental Euroization of the Hungarian economy, for example.
Yes.
Singapore, very important capital center, but next to some very big economies with central bank digital currencies already. How important is the monetary sovereignty motive for these developments, would you say, CBDCs in particular?
Definitely. Even one of the Project Dunbar, if one of the outcome which came out of your Dunbar research is precisely those issues, how each country maintains their monetary sovereignty in the network, how much of that risk they'll take, because you need one interoperable reserve currency. And there'll be a massive gap if every country wants to believe that their currency is liquid enough in the market. So there are these underlying structural challenges. That's the reason I don't think large value can run out of dollar as a result.
It will continue to be account-based.
It will continue to be account-based because you need a dollar-based reserve currency to settle all this large transfers. It's just the market reality.
That's right. Naveen, there is a challenge essentially going out to you and other commercial banks, I think, to reduce cross-border transaction fees, implicit or explicitly in what Rana and Sopnindu have said. What is your response to that? Will commercial banks pick up this challenge, use this new technology, notwithstanding all the regulatory costs that you have to contend and that people want you to keep?
I would argue that we are already rising to the challenge, John. I mean, if you think about the work that we're doing in Partier, along with DBS Bank, Standard Chartered, and Temasek, it is about creating those cross-border RTGS rails that Andrew was talking about. You could build all sorts of interoperability between domestic payment infrastructure, but you need to move liquidity. Till the point of time you are able to move liquidity, especially in this world of QT and scarce liquidity, money is no longer free. That becomes a game changer. That is how you start reducing the costs. You start reducing the costs by taking out settlement risk, having FX PVP, payment versus payment, so that you're not exposed to settlement risk. You don't have to go to CLS, wait for T+1, T+2 to get delivery of currencies. That is what is going to take out costs. So we are actively working on that through Partier, which is an account-based solution. And to Sopnindu's point and Andrew's point, and to a certain extent what Rana said, for low value, we are looking at deposit tokens. Mm-hmm. Like when Sopnindu talks about, you need stable coins. My argument is, why can't that be commercial bank based, right? We will issue tokenized deposits. Tokenized deposits or deposit tokens are intended to be bearer instruments. So we are addressing that challenge in those two manners.
And what currency would the token be in?
That's a good question.
No, the currency would continue to be, the tokens would continue to be the current sovereign currencies. I don't believe that there is a need for a new currency. As long as you can have FX done, PVP, and get instant delivery of currencies, there is no need for a new sovereign currency.
Right.
I mean,
then I think his point was that if a JP Morgan wants to move a tokenized deposit, it will be dollar or will be different sovereign currencies?
It will be different sovereign currencies with FX being executed instantly. Yeah. So if you think about JPM coin,
and the second part is, will it be a currency swap between a non-dollar settlement?
Yeah, so it will be an FX swap wherever required. Not an FX swap, an FX outright trade which will be executed. Today, the issue a little bit with FX markets is not on the trade side of things, but on the settlement side of things. So you have the ability, if you have the ability to instantly swap or settle and get delivery, you don't need a new.
So that's why the low value can get through, because low value, not big size. Moment you reach a certain threshold, you need dollar at that point.
The challenge with the low value currencies, though, and BIS has done some excellent work looking into that, is with interoperability models. There are different models for that, and there are implementation costs to make things interoperable between different currencies. So the use case kind of has to justify the interoperability model that delivers enough efficiencies. So there's a bit of a cost-benefit analysis. But today, how many, like, let's see a show of hands. How many intermediaries are typically involved in sending $200 from one country to another on average? Oh, that's a lot.
I think 4 is
spot on. It's 4, but it could go up to 7 in some cases for the less trotted corridors.
In a remote village, you can have up to 6, 7.
And maybe just to pick up from Rana, one also has to ask, why is that the case? It's not that banks love to create this complex web of accounts. It is the cost of compliance.
Yes.
Right.
So, I mean, if it is same activity, same regulation, and you remove the regulatory arbitrage which exists, my argument would be banks can also do peer-to-peer transactions.
Swift points out actually that the payment system will be as fast as the slowest part of the regulation in the transaction chain.
Yes, that's right.
That's not a technological answer that's required, I think. Andrew, the FX topic comes up again and again. Sotbindu and JP Morgan involved in a project trying to experiment with FX between CBDC, and I have to say I didn't properly understand it, and I don't think it's completely finished. But we'll come back to that in a minute. But how can we solve for FX in terms of interoperability, either between fiat and digital, or between different digital currencies themselves?
Well, I spend exactly 0 time thinking about non-fiat digital currencies. So just to put that out there, again, like, so the FX is all about, to Naveen's point, the trading part is relatively solved. I mean, that's not complicated. It's the settlement of it, right? And it's the liquidity in these odd pairs. So if we look at even this region, if you were in Thai baht and Filipino pesos, it's kind of an odd pair. USD, You're going to need somewhere else to go, and that's the US dollar usually. So that fundamental kind of construct, whether it's tokenized, stablecoins, CBDC, current payment rails, it doesn't change, right? It's a complex problem. It's part of it's a necessary, evil is not the right word, but it's a necessary part of the payments value chain. And so I don't think any of these technologies are inherently going to change or solve any of that. So it's really about, as we get to a more multi-currency world, and as use cases emerge where you do need more velocity, and you need, the settlement infrastructure to support that velocity, that's where I think opportunities come in to sort of, how do we create those always-on services that don't require T+2 type activities, and how do we add more currencies to those baskets that CLS settles 20 or something, 18, and it takes many years to add the 19th and the 20th. It's a process. It's a heavy duty process for good reason. So how do we create these lightweight infrastructures, or maybe it's commercial bank money settlement, and people understand the risks that are there that are different than settlement in central bank money, like what CLS can provide. But how do we create, maybe tiered those FX settlement infrastructures to allow for these more digital native use cases to emerge, and do it in a sound and safe and secure way?
Would it be possible to do that without price inputs from commercial banks, the trading floors of commercial banks?
I mean, the price discovery process is what it is. You do need some sort of mechanism to do that. There's some fancy stuff in the crypto world that I don't, AMMs or whatever, that I don't know if they're necessarily more efficient or not than the order book models that we have today. But in
that experiment we have done on the automated market maker, there is those technology stack we have taken from the crypto market experiment. and the Project Guardian, and they're also doing those things to discover efficient pricing for FX automated market.
Yeah,
do come in on that.
Yeah, maybe to add to what Andrew said, right? Like I mean, it is arguable whether AMMs provide better price discovery than traditional OTC-based markets. But leaving price discovery aside, there is fundamental value in terms of how FX settlements are executed. I'll come back to the point, right? Like, why does CLS have only 18 currencies? Because CLS uses the risk-free settlement asset, which is central bank money. So CLS Bank needs to be part of RTGS systems. So that takes time, and that you need to get the appropriate licensing. And even after you're part of the RTGS system, you have to coordinate the netting between overlap of RTGS systems. RTGS systems are not 24/7. All of this is what create constraints. To Andrew's point, commercial bank money executed or settled through AMMs means you could get immediate delivery of currencies. You could get customizable netting windows. Those are some of the infrastructural uplifts that can be done to make the process more efficient. And to Rana's point, you can start bringing down the cost.
And they're pre-funded.
And they're
they're all pre-funded. So the market risk are minimal there.
Right.
So you're pre-funding a common pool. You are just moving netting process. So it's kind of technology efficiency gain there.
But what I'm essentially hearing Sopninder is if you want to deal cross-border through regulatory constraints, and you want to go from one country to another, you probably need to be going through a commercial bank to do it.
This efficient rail today, and I think let's go by the pragmatic approach today. And I'll use Singapore example. In Singapore, 2006, 15, 16, we focused on domestic market. We made it super efficient. You can move money within Singapore, 0 cost, 3 clicks, pay now, done. There's no need for a fancy currency here. Then we looked at overseas. We took 3 years to connect to Thailand. Well, we have identical systems, so-called. We took 3 years to connect to domestic payment system. Why? Huge policy gaps between two countries, despite two identical system, regulation, and we had to settle that. The only reason we could settle that in 3 years' time and manage to send money on the domestic network-to-network peer-to-peer connection is because there are certain agreement between two countries on certain rules when money is sent back and forth. The impact of that, for every $100 a Singapore migrant worker from Thailand in Singapore send back money home, today they spend $3 as against $15 on a regulated network through commercial bank existing processes. So not bad. From $15 to $3 cost, dramatic drop in the expense, including FX and all. You add $5, it's still competitive. Then we are connecting to India now. It took us close to a year. And I think India pricing will be almost identical, $5 to $3 per every $100 you send back home. Now the question you're asking, can we, using some of the work Dunbar, Project Dunbar, Nexus, all these learnings we have gathered through multi-jurisdiction connecting the domestic payment system, some CBDCs, ideas on settlement side, can we make this process sub-dollar for efficient? Which means commercial banks are still playing the role in moving money, but the settlement efficiency is gained by adoption of wholesale CBDC. And the network is not a bilateral, it's a multilateral connectivity through the Nexus specs, which BIS came through.
We'll talk to Andrew about that.
Yeah, so I just want to set the context, what you're trying to solve.
Yes.
You're trying to solve a cross-border payment.
Yeah.
We have gone halfway there by showing the world that we can connect to domestic network. We can use existing bank network to do it. The question we are asking, do you need a correspondent bank to settle cross-border? And that could be a bold choice to be made through wholesale CBDC as a model.
And in a very simplistic terms, in answer to the question, why bother, your answer is essentially financial inclusion.
Yes, absolutely. And even if as a long term, even take a high value, we can make things more simpler. Of course, as the initial use case, we are driving at financial inclusion, low value transfer to prove that point. But imagine the low value transfer is not small. Singapore to India remittance is $1 billion annually. It is small ticket size, but numbers are big. India receives globally inward $80 billion of remittance, small value. So numbers are really huge. And imagine for every country which today, let's say case of India, when India receives $80 billion today, implicit loss of revenue is close to around $15 billion on top of that. Somewhere it's lost. By fixing this problem, poor people are going to get on top of that another $15 billion.
Right.
So we are really solving a problem through this network connectivity and this thing. But as an outcome of that, if the things become super efficient, large value also take benefit of that. Why not?
Okay, and there are all sorts of interesting wholesale capital markets applications. We'll look at those perhaps in a moment. Rana, I wanted to ask you what you thought about the original Facebook idea. It quickly went out of fashion and was squashed quickly by regulators, but seems to me quite an interesting idea to create an SDR that would move in a very well-populated network and get around all of these problems using new technology. Is that still a defensible case, do you think? As I still hear stablecoin pioneers talking about it.
I think the main problem with that was it was not decentralized. There was one entity, to your point again, Subnandu, there was one entity that maintained too much control,
right.
and that's the risk.
Yeah.
With different stablecoins that exist today, whether as MiCA, Markets and Crypto Assets Regulations in the EU recognizes them, e-money tokens or asset reserve tokens backed by a single fiat or a basket of assets that have very complex rules. There is a concept of free competition there. Everyone, any qualified issuer, as per regulations that have come out and will need to come out in different places of the world, can issue a stablecoin as long as it meets the necessary issuance guidelines for EMTs or ARTs.
Yep.
And that was the problem with Facebook's version of it. It was there was too much control sitting with one entity.
Yeah, and the central banks do talk about preventing walled gardens and rent-seeking monopolies and so on. So that's what you're addressing. Andrew, tell us a little bit about Nexus. This is an interesting answer, not completely finished, but a very interesting answer to some of the interoperability issues, which will allow a heterogeneous evolution of lots of different systems that might also be able to talk to one another to solve some of these cross-border issues. Tell us a little bit about that.
Yeah, briefly. So it really builds on what Sapnendu was describing in terms of the Singapore, Thailand, and now Singapore, India pilot projects that are live. The beauty of what they've done is connect two networks, right? And of course, we have to remember that whether it's current payment rails, card rails, stablecoin rails, future state CBDC rails, all of that depends on a network infrastructure, right? And that matters a lot, right? Because that's where the reach is, and that's where the scale of a payment system comes from. So the observation was, if we have this critical mass of domestic fast payment systems, those networks have reach, and more so they extend even beyond banks. So there's access models for fintech providers who are regulated and licensed to join and participate in those schemes. So there's an evolution there. We thought, connecting these networks is an obvious place to explore. It's a logical next step, and so it's a counterbalance to some of the CBDC and stablecoin discussions, I guess. But the issue that we observed with the bilateral connections is that they're inherently lacking network effects, right? You can't really have a network effect if it's just two currencies, two countries. So we just took the idea and tried to scale it in a way that would somewhat standardize how these systems would talk to each other. And I think there's other projects as well that are doing the same now, which is good. So I think we've catalyzed, a bit of a global discussion around what the opportunity space looks like in interconnecting fast payment systems. And there's many dimensions to it that kind of too many to go into. But how the kind of the flow and the money movement, the messages pass and are standardized. All of the issues around your customer AML and sanction screening come in. What data do you need to automate those processes? Because actually that reduces a lot of friction, removes costs. So we tried to really take a run at consolidating all of that using a lot of existing standards like ISO 20022 and put it all together in a fairly coherent package. So we're pretty proud of that. We're going to be publishing the next iteration of the report in January. And we have kind of some more work to announce next year as well, and supporting some multilateral kind of projects in that space.
I've got one or two other questions about Nexus, but I wanted to offer the audience a chance to ask this excellent panel question. So hands up, please, for anyone who has a question. I'll come to all three of you. So you, sir, here in the white shirt. Perhaps you could tell us where you're from as well. That would be great.
We can hear you. No?
Yeah, it's good.
Question around, okay. So my name is Kenneth. I'm writing a book about DeFi. My question is around your thoughts around DeFi as a global fintech infrastructure. Because in a sense, my train of thought is around who builds the fintech infrastructure within countries, right? We have Aadhaar, we have PIX, and it's the government that builds the infrastructure, right? This is a public good. It's an interoperable system. Now, who is doing that on a global level, right? If in a sense, blockchains already do that, right? Now, is it that this blockchain system is essentially just the Wild West, and it's very hard to regulate that makes it a terrible fintech infrastructure, or is there potential there as DeFi as a global fintech infrastructure for those reasons?
Yeah, I think it's a very good question because, and this question is more, I think this question has become very important now after this disaster in ASX, that I think this desire to build a controlled state-sponsored network for an idea of DeFi is not going to work. It just doesn't go. It does
like a contradiction in terms.
Yes, it's absolutely not good work. It has to take a shape of what internet did to us. Nobody built internet, but the underlying. So there has to be some magical way, and who will do it, where all these networks and servers and find a way to do this decentralized public blockchain as an alternate or the new form of internet. I think we have to go back to the drawing boards and start thinking about it again, grounds up. I think it got somehow, the world got distracted to make it commercially attractive and to not get regulators going after them. The public blockchain networks shifted to permission and all kind of centralized based model, trying to make status quo happy. And they lost that desire to build an alternate open distributed network. It is not commercially ready or useful now, but I think we all have to reflect on this, go back and build that model. That truly decentralized network is the way to go in future if there is any chance of real success out there.
Essentially a set of standards that don't particularly belong to anyone.
Yes, indeed. I think that's the only way. And then you can have, I think somebody made this statement, you can regulate things on the edges, not on the, I mean, how can you expect a central bank to regulate a protocol? Today we regulate the banks. And we tell bank, you are responsible for what you're doing on the internet because you are in charge of customer. We don't regulate the HTTPS protocol today. We don't tell how the protocols are running. Why do you expect banks to do DeFi protocols? But we are doing it now as an experiment. But I think that's we are coming to a point of reflection on that. Is that the right model to do? That state will or any consortium should come and together and build this permission network, which actually end up in same disaster what we saw a couple of weeks back. So that's my response to that question. But I want to give a health warning that we really have to go back to the drawing board again. Really, way back. You can't call it a success with what has been built now. You want to comment?
This is similar to the project we've just been talking about in a way.
In a way. Although trying to zoom out a little bit and try to respond to the question, and governance of the internet is messy and complicated, right? And it does depend on standards. And there's organizations like W3C who help and try to govern the standards and the chain, that allow this magic to work, right? So that exists, but it's messy and it's very imperfect, and security is terrible, right? We know that. And there's also been splinter groups. So the big tech companies have splintered off and created the What working group that basically owns HTML. Yes. So the HTML standard is now effectively controlled, from what I understand, by the three big techs. Yeah. Okay? So the question we have is, we're talking about money, right? We're not just talking about information.
Yes.
And what is that minimum level of governance that we require to have confidence that this network will actually serve our needs and provide those core services security and assurance and create trust that allows us to make something like this work? I don't know the answer.
Doesn't that push you back to the organizations that Naveen and others work in? Isn't that what banks do?
Not necessary. I mean,
Right.
they're still at a layer above that, which will be regulated to operate in a similar.
Right.
Today we have some regulation on the ISP today.
Yes.
Well, they all run the same, right? Today we do regulate ISPs in some form. You tell them how to behave.
We have what are known as the principles for financial market infrastructures, right? And that came out of the BAS a few decades ago, I guess. But those are principles; they're not standards, and they do attempt to describe all of the operational, legal, the different types of elements. There's about 27 of them, or I should know the number, 24, 20 something. But it really does cover the gamut of all of the kind of dimensions and considerations from a governance perspective that are required to, we think, create trust in networks. And if you take DeFi and you take what is the infrastructure in DeFi, I guess you'd have to say it's Ethereum today, right? As a maybe the majority leader or what a market leader. What is the governance model of the Ethereum network?
Yeah, it's very complicated.
Right. And is it anywhere close to meeting the principles for financial market infrastructure?
Well, I mean, it's a technological. It's its own universe.
The answer is
right. So
right. Like
that's
you
why
don't even know what we don't even. There's no legal underpinning. There's no clarity around the governance model of decision making. We don't have a clue how actually any of that plays out. Right. So it's nowhere close to meeting what we would say is the bar for financial market.
Which Project Guardian is trying to address.
Andrew mentioned an important word just a moment ago, which is trust. You think that systems should be designed not to need to rely on trust, I think. We talked about that at the IMF.
I think he made a distinction. Moving information is one thing, moving money is the other thing.
Yeah.
Okay, and if you want to move money, and there's some set of liability you carry with that. Today, on internet, of course, there are liability. I cannot speak bad about him. He can sue me on the internet. But when you move money, there's a real liability, right? It's real. You have to ensure that the counterparty risks are managed. There's a real challenge out there. So there is a different set of protocols we have to think through. But my argument to his question was that let's not try to take that lovely idea which is called distributed ledger technology and make it look like a centralized database, which happened today, which is the root cause to all this problem.
Right. Rana, where your institution to an extent might represent this nirvana, do you want to offer a defense of it?
So DeFi in particular, I think will see a lot of interest from global standard setting bodies. It was intentionally left out of the scope of the markets and crypto assets regulation, which is the most comprehensive crypto bill to date, because it's so complicated. And it goes back to the point of what trust actually means. People put their trust in regulated banks because it's so hard to get a bank license. My previous employer was a fintech company, and working on just getting bank licenses, it is so strictly regulated for a reason, because then you trust the bank with your money.
And the governments are on the hook for deposits as well in many cases.
Exactly. And then this is where central banks come in to provide that layer of trust. So if the bank goes bust, the central bank has your back. Now, trying to mimic that trust-ish
the FDIC
to a certain extent,
or similar, and not the central.
Yeah, I mean, and trying to mimic that concept of trust and what it actually means for a DeFi project on Ethereum or on the Binance Smart Chain or any other is going to be complicated. And I don't know if anyone has the answer yet.
No, I don't think so. I want to come on to the other questions in a moment, but Naveen, I want to tackle this topic from another angle. There's a thing called the Regulated Liability Network that Citigroup and others talk about. You're not in that yet, I don't think. But one can imagine the commercial banks eventually creating a thing like a market, 10, 15, 20 years ago, whatever it was, which was to solve for OTC derivatives pricing, which no one could provide. So the banks formed essentially a cooperative to solve the problem. How likely is that with DLT platforms eventually?
Yeah. So, I mean, maybe just to answer your questions two different ways. One is Regulated Liabilities Network. Essentially, it mimics the idea of what Partier was in terms of trying to create a shared ledger infrastructure and a two-tier infrastructure between commercial bank money and central bank money. Yeah. So, And the second point I'd want to bring is that, what Swapnendra was saying, creating these walled gardens or permission blockchain, are you sort of corrupting the whole essence of what DLT is meant to be? I don't necessarily think so. Like, if you think about Ethereum, the move to proof of stake, I would argue is a move towards centralization. There are a select group of people who are, but I do agree with Swapnendra that,
But the reason they move because they want to make everybody happy.
Well, so there is no other DLT at scale, right? Like I'm saying.
So that's why go back to drawing board and figure it out.
Well, so my point is that all of these permissioned blockchains, can be side chains, can be layer 2s onto public blockchains. And that is what creates the interoperability.
Right.
One of the things that I wanted to make, which Andrew said, was interoperability is important not just from moving liquidity. Interoperability is important from getting the singleness of currency or oneness of currency. Today, when you have a JP Morgan dollar, you don't call it a JP Morgan dollar, you call it a dollar. You call a DBS, you call it a dollar. Because of the singleness of it, the fungibility between central bank money, commercial bank money rails, that is what we need to create. Like, if you think about stablecoin, there is no singleness of currency. I mean, a Binance USD is different from a USDC, is different from a USD.
It might one day be plugged into RTGS, though.
Potentially creating that singleness. So we as Onyx are looking to solve for that. Like, as banks, we are uniquely positioned because we are part of RTGS, we are part of PIX instant payments, and we are looking to be part of these new rails so that we can create that singleness of currency.
Right. Okay. We two other questions, please. You had a question, and I'll come to you, sir, in a moment. You here in the red dress.
Hi, thank you.
Sorry, he's got the microphone. We'll go ahead first. I'm next to you, please. And say where you're from, please.
Eric Pascal from Standard Chartered Bank. Thanks everyone for the opportunity and the interesting dialogue. So I know most of you, so don't take this personally. This question is pretty much for all of you, but the fundamental element that all of you are bringing to bear in this discussion is the necessity for a connection into fiat, into what we call the real world economy. So my question along those lines is, account-based or token-based, how do we enlarge and scale given the dependence on those models, which almost by definition rely on a central bank or at least a regulatory authority providing the clearance and the ability to engage and generate this form of liquidity? So that's question one. Question two, sorry, Rana, to pick you out, but I've heard a lot about CZ, getting involved in a lot of different aspects of the market. So the question for you is, in terms of tokenized deposits and potentially when we get to the point where we can interoperate CBDCs, what's Binance's end? What do you guys get out of that? Sorry, thank you.
How does Binance get out of what?
What would you get out of CBDCs?
And
probably nothing. But
actually, we get a lot. So we've responded to various CBDC consultations around the world, and we're actually participating in both like technical advisory and in providing the infrastructure for some of the CBDC pilots around the world. What CBDCs do is they bring some level of trust in a version of tokenized assets that comes with the issuer being a central bank, with all the benefits of being on the blockchain. And I know you look like you're a little bit skeptical of that, but it is a major driver of adoption. And there are a lot of benefits associated, again, with costs, speed, transparency, and access that CBDCs bring that other forms of, may I say, stable coins wouldn't necessarily bring. And they are and might be, in my grandchildren's days, they might be the equivalent of a fiat gateway in the future. There remains to be a lot of research needed into the use cases. There's a lot of evidence that wholesale CBDCs, for instance, CBDCs provide a lot of benefit for wholesale payments. There remains to be a lot of research, honestly, on the remittances and retail side.
The Bank of England says quietly that wholesale CBDC is RTGS. It essentially already exists. So Thank you. Right on the first question, perhaps you can take that, Sopnendu, which was about on-off ramps.
I didn't get the last. What are the question? What should?
Sorry, yeah, it's got lost in translation, I'm sure. But no, the question is in terms of the linkage with the real economy and fiat, given either in a token form or an account form. Okay. Yeah, our concepts of M1, maybe even M0 require scale, I think, in not just, kind of pure volumes, but the ability to develop and scale across borders in different countries, and not necessarily all currencies, but yeah, let's talk about G10, G7, et cetera. So the dependence on that ability to scale, from what I understand, is frankly a linkage into a central bank allowing it, or creating the enablement for deposits to be tokenized, for a JP coin, for example, to be acceptable as an account-based registry on a ledger that then gets insured, etc. So how do you scale that across the world?
How do you scale that? I have no answer to that question. Well, no, I mean, it's too early to. I mean, we are at a very, very early stage of that development, and I think if you take wholesale CBDC, I mean, banks indulging in tokenized deposit is how many? 2 years? 3 years now?
3 years, yeah.
3 years now, and there also the initial uptake has been limited to few evolved or enlightened bank, so still at a very subscale state. I think CBDC as a central bank issued digital currency, my bet is it will take a scale if 2 or 3 large market truly takes it as a part of their monetary system.
I think maybe just to answer that question a different way, recently, I don't know, many of you might have seen the MAS consultation paper on stablecoins. There are 2 really important points in there, Eric, to your question. One is the stablecoin payment rails or blockchain rails as designated payment system, number 1. And number 2 is according the status of settlement finality to transactions settled using stablecoins or tokenized deposits. I think those 2 things enshrined in regulation is what is going to give credibility and scale to what we are doing.
And even that stablecoin, well, BIS still calls it so-called stablecoin in all the paper, right? So-called stablecoin. I think MAS is only central bank which actually has put a statement out there saying that there is a possibility of a well-regulated stablecoin. But I think it's still something to watch out for, because you really have to figure out what purpose they serve. And if you don't solve that, it becomes a well-regulated stablecoin doing nothing. So you got to ensure that it really solves certain problem statement.
That's why the metaverse is coming.
Yeah,
albeit without legs at the moment, I think. But
maybe that will be a new form of money which will be used to transact on the metaverse. Possible, because it's a bearer asset in that sense. But I think
that's an important point. So if I watch my children, they are perfectly happy with digital currencies in the metaverse, in things like Fortnite and so on.
So that's what Ravi Menon in his speech meant, that there is a need for a new form of money for this new type of assets, which requires this kind of money.
Yeah.
But that is future. We got to. I think the cryptocurrency is a brilliant marketing strategy to use currency after crypto and a coin after something. I think the marketplace for this kind of this form of money doesn't exist today.
Right.
It has to exist. It has to thrive before this new form of money becomes.
Web3 will need a currency or currencies.
Yes, and that has not yet developed.
Yeah,
it is too early to. The marketplace has run ahead of the currency.
Yeah,
and it's not just within Web3. There's interest now in using stable coins and CBDCs in the Internet of Things, as they call it. So for things like machine-to-machine payments, and I know that sounds super futuristic and a little dystopian. I can share my views on that outside the room. But it is a growing economy, and there is a lot of interest in what role stable coins could play. I mean, at the end of the day, if you look at the evolution of money from barter systems to seashells to gold coins to gold-backed fiat currency, and then fiat currency that is no longer gold-backed. The concept of money boils down to three things: acceptability, like to the extent to which money can be exchanged for goods or services; fungibility, so like $1 is fungible for another, or one stablecoin is fungible for another, given, and then the third, stability of value. So to the extent that any form of payment can provide you with these, it will be this is what drives the adoption of any form of money or payment.
And I thought when what is not Binance? When Armstrong, what is Brian Armstrong's one? The Coinbase announced that they will Google Cloud. You can buy cloud access to using Coinbase. I thought that was a opportunity to super scale, but it was wrong timing. It didn't take off because you just need a moment of that as it says, a well-regulated stablecoin regulation could be a trigger point. It could be a large infrastructure demand, or metaverse suddenly demanding this huge need for such coin could be the tipping point. Very early now to get that tipping point.
Naveen, and then Rana touched on something that sounds like a nightmare for the transaction services heads of banks, which is corporate treasuries transacting directly in stable coins.
And just before you don't miss, I think one point I didn't want to miss today is that one of the reasons why people are still talking about CBDC stablecoin is that this network, which he talked about, is still a privileged network. You need to be a member, you need to be a bank or regulated by.
Yeah.
I think the lack of access for third-party wallet provider to this network also has created this demand for alternate rails. Right. We may dislike to say that, but I think that's the reality. Why you have this alternate form of money getting transmitted, because there are these front-end apps which exist because they're not part of the network.
Right.
Sorry.
Carry on.
So I just want to get to his.
Quickly, then I'm going to move to our final question. Please, Andrew.
It's okay.
No. I have to get to that spot. I don't want to miss this.
But so the point is, though, yes, there are limits to access, and for good reason, right? So even MasterCard and Visa won't allow someone to fund their online gambling account, right? And so there's reasons for that. And so I think it's a question of there are unmet needs, and how do we expand our payment rails to meet as many needs as reasonably possible, but within the risk appetites that exist for good reasons. And so there definitely are legitimate use cases, and whether it's small and medium-sized business needs or other emerging digital economy needs, or competitive reasons to have different payment methods accepted on e-commerce sites and QR codes and all this great stuff. And the providers should be given access to the traditional payment rails and regulated as participants in an appropriate way. And that's the place we should focus our energy, I think.
Yeah.
Okay. Please, far away.
Hi.
And please say where you're from.
Yeah, my name is Cici. I am from Van Link Partners. So I was a FX trader for many years, and also a portfolio manager for a DeFi asset manager. So my passion is in financial inclusion, which is supplement to touchdown for small amount but many users, right? So my question number one is, for the AMM you mentioned for the exchange rate, how do you envision that to happen? Is that going to be currency pair against US dollar again, or is, for example, going to be pesos versus Thai baht in the AMM? And I'll have another question for Naveen.
That question for him. The commercial bank has to free fund those pools.
And it's for the commercial tokens. Sorry,
Deposit tokens.
Deposit tokens. I'm just trying to understand. Does that mean all other banks will need to be on board, so you can actually creating a network? And then how does that compare to the Chinese CBDC? Because my understanding is Chinese CBDC requires basically commercial banks creating their own wallets, right? Basically, at the end of the day, in the future, whoever the banks creating the wallet and has the ecosystem with that wallet going to be, the win the race, right? So how does commercial tokens compare to that?
That's an interesting question. Thank you. Naveen, we haven't really talked enough about the Chinese CBDC experiment today, so we've had so many other things to talk about, but it is an interesting, probably unique case. There are lots of reasons why it can't be applied elsewhere, but please take the question.
Yeah. So in terms of the ECNY project, the banks are essentially acting as distributors, right? So, and there's a two-tier model for that. As John said, and to a certain extent, I agree with Rana, right? Like the retail CBDC use case, I struggle with the retail CBDC use case. In the instance of China, it was about providing alternatives to the duopoly of WeChat Pay and Alipay. There's a specific use case. In India, people are still struggling with what exactly does a retail CBDC do when you have a very well functioning infrastructure like UPI. So so retail CBDC I'm not sold on. I disagree with John on wholesale CBDC being RTGS, because I do think that wholesale CBDC linked to tokenized securities can provide interesting DVP capabilities, atomic settlement capabilities. So compared to now to your question on what does deposit tokens do, I look at it very simply. Today, when you make payments, digital payments, almost all of it is commercial bank money based. When you talk about going into digital currencies or blockchain based rails, it's going to be no different. There are fundamental reasons as to why that is the case. And I can go and talk about credit disintermediation. For example, if commercial bank money were to be displaced by central bank money, it will interfere with the credit creation process. There are a whole host of reasons why the two-tier architecture works. So our point in terms of creating deposit tokens was replicating what works very well today in terms of the two-tier architecture onto blockchain rails. So that really is the intent. You asked a very interesting question in terms of, well, JP Morgan issues a deposit token. How do you create interoperability between a DBS token or a Citi token? The same way that singleness of currency is assured today, right? Like singleness of currency is assured through RTGS, through central bank backstops. The same process is going to apply today. We have an extensive correspondent banking relationships with many of the banks. Each bank routinely has credit lines with each other. That creates that fungibility and the ability for a JPM issued deposit token to be accepted, for example, by a DBS customer.
So you're digitalizing the remittance service.
So the use cases around it is, one of it is definitely remittances. The fundamental way to think about it is to create peer-to-peer payments. Today, you don't have peer-to-peer payments other than cash. That is the only peer-to-peer payment that you have. Other than that, there is no peer-to-peer payment. It always goes through a set of accounts, and to Rana's point, at least 4, if not more, cross-border payments. And that is where is the opportunity to solve for it. There are a number of risks that we have to solve for. With bearer instruments, there's a good reason why people moved away from bearer instruments. We have to solve for that, but the technology gives us certain options.
Is it that what Governor Das, RBI governor, just spoke yesterday? He said that the reason why India is interested on the retail CBDC is actually to replace cash. And he actually made a statement that they will maintain the anonymity of cash. Yes, that he said yesterday. And which means that the mental model for retail CBDC is a cash replacement. In a way, you are replacing payment system, because once you make it tokenized, you don't need a complex payment network, and you can actually move mobile phone to device to device. You can move money offline. As China did 10 transactions offline. So I think there is a certain innovation, technology innovation at a low end for certain far-flung cities, and also where you have infrastructure challenge. I think both the central bank are thinking about creating a cash equivalent. I don't know China case. I think there's not official stated position, but in RBI governor yesterday said, yes, we will put a tokenized cash and also be anonymous, which means it is a.
So it won't disrupt the informal economy.
Yeah, it's a way.
And to another question. Do you see there going to be a divergence in the world? For example, the West very conscious about the privacy, right? They don't want the government track.
That's the point.
Yeah, this comes up in every CBDC debate.
And that's the point. That's the point where Governor Das made a statement. It will have the feature of anonymity as cash should be. And in China case, I don't know. I can't make the statement there. It's not clear. There's no official statement there. I can only guess. But I think for those cash tokenization, we have to maintain the attributes of cash, why it exists in first place.
We've surveyed this actually. You're right. The places like Germany and the US, there's very strong resistance to any state-based cash platform unless it ensures anonymity. And if you do that, how are you protecting for KYC, AML, and round it goes. So it's a good question. We've run out of time, but you were really excellent panelists, very open and engaging, interesting. There's an enormous amount that we haven't covered, of course, but I thought you did the horizon justice. So thank you very much, everyone, and thank you for staying with us this afternoon, and thank you to everyone watching on Catch Up and online. Have a very nice evening, and thank you for joining us today.
Thanks for having me.
It was interesting.